Good morning, traders, and welcome back to today's daily analysis. Today's Wednesday, 26th June 2024, and here are key things you need to know for today. So, for the US dollar index, on Monday, the index fell to around 105.4. This was after a series of gains since early May, with the investors taking profits ahead of what was expected to be the turbulent week. When we look at a broader outlook for the US economy, the situation remains mixed. There are some signs of deflation, but the Fed officials have adopted a cautious stance, avoiding a full easing cycle. This cautious approach has created a sense of suspense in the market expectations. Interestingly, the US dollar index have strengthened for the third consecutive week. This strength is mainly driven by better than expected initial PMI readings and continued hawkish speeches from the Fed. Now let's dive into the technical analysis. The US dollar index was last reported at 105.46, maintaining mild bullish momentum on the daily chart. Some key technical indicators: the RSI is currently at 54.75, which indicates the market is above the neutral 50 mark, though it is in a trending downward. And the MACD is showing green bars, suggesting the bulls are in control. The index remains above the 20-day, 100-day, and 200-day SMA, indicating positive layout. Combining these conditions, the dollar seems to have likely to rise further, particularly if it holds above the key support levels, such as the 20-day moving average at 105, the 61.8% Fibonacci retracement level at 104.8, and the 200-day moving average at 104.47. On Monday, the oil prices went up but then fell back as traders took their profits. This drop happened because of the Republic of Congo added more oil to the market, increasing supply. And at the same time, the US dollar index was trading above 105.5, and European stocks caused some market jitters. On Tuesday, the WTI crude oil was trading around $81. There are few reasons for this price movement. First, there's a lot of talk about strong demand for oil during the summer driving season. Plus, ongoing geopolitical tensions in the Middle East are pushing prices because there's concern about the oil price from that region. The summer driving season usually means people are more on the road, so there's increased demand for oil. And with tensions with the Middle East and Ukraine, there's always the risk of disruptions in the oil shipments, which also supports higher oil prices. However, on the flip side, the stronger US dollar and Fed's hawkish stance could put pressure on oil prices. When the dollar is strong, the oil become more expensive in other currencies, which can also reduce the demand. Also, higher interest rates, as mentioned by the San Francisco Fed President Mary Daly, could slow down economic activity and reduce the oil demand. You can see here on the daily chart, we see some bullish momentum. Right now, the oil is trading above $81 and is slowly moving towards 81.5. If it breaks to 82.12, which was last Friday's high, we might see it go up to 83.5 or even 84.14, which was the high of April 26. On the downside, there's strong support at $80, which is a key psychological level, and at $79.04, which is the 200-day moving average. If the price drops further, the next level to watch is 78.33, which is a significant Fibonacci retracement level. And then lastly, we have the gold prices edged lower to 2,320 in the US session after trading near 2,330 yesterday. This drop happened as the 10-year Treasury yield stabilized above 4.2%. The dollar rebounded following hawkish comments from the Federal Reserve. The gold is losing some of Monday's gains due to the increased market risk appetite early Tuesday. However, the dollar fell among the US Treasury yields because of the dovish comments from Fed policymakers, which helped cover gold some of its losses, reaching around $2,235. But sellers at this point push prices back down. So despite the weak dollar and falling treasury yields, traders are focused on Friday's US inflation data for clues on when the Fed might cut interest rates. Half-year end fund flows could also impact the gold price trends. The gold prices are still following a symmetrical triangle pattern confirmed last week. On Monday, the prices rebounded from the support level at $2,320, but the 14-day RSI is below 50 at 48.95, indicating bearish pressure. Additionally, the death cross on the 21-day and 50-day moving averages is keeping the bearish sentiment strong. If gold prices below 2,320, it could confirm a breakdown of the triangle pattern, possibly pushing prices down to 2,310 or even 2,300. The next key support level is May 3 low of 2,277. For the gold prices to strengthen, they need to break above the 2,335 level, where the 21-day and 50-day moving averages converge. If they do, the next target is the upper resistance of the triangle at $2,358 and then Friday high around 2,368 to 2,369. And that is all for today daily analysis. Thank you for watching, and if you have any more questions, feel free to reach out.